For more on the wage trend, the Fed, and this week's inflation data, let's welcome Nathan Sheets, global chief economist at Citi. I don't know whether you have comments about Steve's report, but if we're finally matching supply and demand in labor and the Fed keeps raising rates, that should work then, because then the demand goes down. We got enough people ready to work. Wages moderate. Unemployment goes up, and mission accomplished. Oh, my God, that's a horrible term.
Well, I think Steve is describing a favorable scenario from the Fed's perspective. And I think he's absolutely right that we are seeing some recovery in labor supply. But my reckoning is that the demand side of the equation, the demand for labor right now, has remained very brisk. And I think the JOLTS data highlight that. And I think in that environment, we're going to continue to see tight labor markets. Yeah, wage growth has been a little bit softer, but still higher than the Fed would like. And I think that's going to continue to put upward pressure on inflation. And I think we're likely to see some of that in the CPI print tomorrow.
Are we at the high end of the participation rate, Nathan? How much higher could we go? Sky's the limit?
When I look at these data, it feels to me that with the kind of prime age, so-called prime age 25 to 54-year-old workers, we've had a nice recovery. But when you look at workers 55 and over, that is still very depressed. And I think that the next kind of round of expansion in labor force participation is likely going to come from that cohort, from some of the older workers who maybe think at the moment they've retired, but over time are going to be beguiled back by a tight labor market, favorable wage conditions, attractive employment terms, and they will gradually return over time.
If I want to characterize people, put them in a box, but the people that say there's too many good reasons to stay home, if you totally took those away in a way that was equitable and fair, what would the normal participation rate be in the view of these people, do you think? How high could it get? How low is our participation rate based on some of these government programs?
When we compare labor force participation rate, particularly for men in the United States relative to other countries, it is remarkably low. And I think a huge question that I struggle with is why is that the case? And I think there are a lot of factors, maybe some government programs, some sociological and so forth that are at play. Probably it's also an imprint of the opioid crisis that we're facing. So I think that there is a lot of work to be done to better understand that part of the participation rate. Our participation rate for women is more comparable to that internationally, but I think that that is another place where there's probably also still, if we can get our arms around childcare and some of these other issues, where there's some upside potential. So, from here it gets harder, with the exception maybe some of those older workers coming back, but it's a challenge, and it's something that I think public policy and Congress should be thinking very carefully about.
Yeah. So there really is something to that argument. Do you think that where interest rates are right now, will just overall demand start to slow?
I think we are getting very close to a place where the Fed is sufficiently restrictive. When we think about, what's happening with the consumer, still some strong demand for services. That's not going to last forever. It's likely to require, a little bit more Fed rate hikes. My sense is that they're going to get into the fives. But I think now the big question that the Fed's wrestling with is how to think about the financial stresses and pressures that we've seen. And I think the acute phase of that is abating. But I think we've all got to put on our seatbelts and watch over the next likely over the next several months to see whether we get into a tightening credit environment that could be characterized as a full-blown credit crunch. I think that's the big question going forward that the Fed is going to be wrestling with in its upcoming meeting.
Well, because they did 25, they're going to probably do another 25. Does that mean they would have been doing 50 without each time? So it's worth at least 50 basis points, the credit tightening from the stress?
I strongly believe that if we had not had these banking stresses, the Fed was signaling it was going to do 50 in March. And I think that they pulled back in an effort to balance financial stability and inflation fighting and did 25. And the way things were going earlier in the year, before the banking stresses, 50 in May was certainly on the table. So I think that, what is the impact of the banking stresses, the financial stability? Yeah, probably it's equivalent to a couple of hikes, as Jay Powell said. But that's just a guess. And in the event, the effects of this could be markedly more severe than what I just described.
Excellent summary of everything, Nathan. Nathan Sheets, global chief economist at Citi, not just around here, just spamming the globe. Thank you, Nathan.